Hi, Debby Benson-Miller with Prime Real Estate Services.
And Ken McCoy, Petaluma Home Loans.
So Ken, today our topic is 3 commonly used terms in lending.
Okay.
Okay? So, can you tell me what is an impound account?
Impound account. So if a borrower typically is putting down less than 10%, or they're doing an FHA loan or a VA loan, they have to have their property taxes and their homeowner's insurance collected with their monthly payment.
Okay.
So an impound account is an account that the lender sets up to hold those money. So though you as a buyer are going to give your money each month when you make your payment to the lender for the taxes and insurance, and they're going to stick it into an account, which is called an impound account. And when that bill comes due from the county for the taxes or your homeowner's insurance, they'll have that money saved up to be able to make that payment.
Right.
So that's what an impound account is.
Well, and sometimes even with those kind of loans, that's not the only way. Some people like to have impound accounts so they don't have to have this big bill that comes at Christmas.
That's right.
To pay their property taxes.
That's correct, yes.
So a lot of people just like the impounds even if they're doing conventional financing.
That is correct. Yep.
So,
what's funny is that people also kind of mistake that with what's called an escrow account.
Mm-hmm.
So they'll call that, they say, well, this is my impound account or my escrow account. Escrow is really something different.
Right.
Tell us what escrow is. People talk about opening escrow and closing escrow. What is escrow?
So if you are a buyer and you are writing an offer on a property and you get it accepted, then the next step is we open an escrow account at the title company.
Okay.
And that basically means we put your deposit in, and that's the time frame for you to do all your inspections and everything that needs to be done, getting your loan done with any other paperwork that needs to be done with your side of it. And so we can close in that 30 days. So your escrow time period is really that period while you're getting ready to close on whatever you're purchasing.
So you're doing all your work, your loan, your inspections, and everything else during that period, and you close it when everything's done.
Right. And on the other side of it, a seller's escrow period is they're waiting for the buyer to do all those things.
Gotcha.
So,
well, what happens, one of the things that happens in there are what are called prorations.
right.
And that's one of those terms that people don't know a lot of times what prorations are. And what happens is when you go to close a loan, not everything, so some bills come in annual bills, like your property taxes, your homeowner's insurance, the interest on your loan. It's the title company's job to break those numbers down so that you're only paying for the exact days that you own that property.
Right.
So when they prorate something, they basically take your taxes, divide it by the number of days in the year, and they're only going to charge you for the amount of days that you own that property versus the entire bill that's due out.
Right.
And so prorations is one that you'll always hear us dealing with in transactions also. I mean, both of us do that.
Right. And I think the key part of that word is prorate. I think
correct.
people know what prorate means, so if you just kind of extend it, that's what it is.
Yep.
All
so
right.
hopefully that gives you a little bit of background on some of the terms that you may learn during the process. We'll be back next week with another tip on Tuesday. We hope you have a good week.
See you then.
Bye-bye.